Good to welcome you to Closing Bell today. I'm at DoubleLine in Los Angeles with Jeffrey Gundlach, the firm's founder, CEO, and CIO. It's good to have you, and thanks for having us.
Well, welcome to DoubleLine. And I calculated that we've been doing this. You'll be surprised. This is our 37th time that we've done this in relation to the Fed, which is, it feels like a lot less than that, but that's the way time goes, especially when you get older.
Yeah, and we've had a lot to talk about, obviously, in that stretch.
Yeah, it's been all over the place.
Yeah, give me your reaction to what you got today, to what the Fed chair himself called a risk management cut, as he suggests the risks have grown.
Yeah, I think the phrase of this press conference is challenging situation and no risk-free path forward. I think what really surprised the markets a little bit, and what led to some of the reversal on what was lower interest rates and what the stock market, was that when he said there was no support or very little support for a 50 basis point cut. Because I know the chatter going into this meeting was a lot about maybe they'll go 50, but it sounds like that wasn't even a consideration. And he also said, which he says pretty much every press conference, there's no predetermined path for interest rates. I thought Steve Leisman asked an interesting question about the word recalibration disappeared. Frankly, he didn't say recalibration, but I think there was recalibration. And, you know, I always talk about the spread between the Fed funds rate and the 2-year Treasury, and it was getting pretty out of whack. It wasn't like it was a year ago when it was the most out of whack in my career, but it was out of whack, and so the 25 is there. Very divided opinions about what should happen for the rest of the year.
To say the least. I mean, yeah. I'm wondering what you make of that. I mean, there is huge disagreement. So one member wanted 5 more 25 basis point cuts. We can only assume that that's Mr. Myron. Sure. 6 project no more, and 9 see 2 more. So there's a massive disagreement.
All over the place.
What do you make of that?
Well, I think it ties in with Jay Powell's comments about the labor market. He seemed genuinely surprised or confused, maybe is a better word, about the 1.7 million job revision downward, and the most recent one, 900, and I think it was 918,000, which are really big revisions. And he seems a little bit confused also about how the labor market has shrinking supply and demand. And I'm a little bit concerned that the consequences of this path downward from about 120, 150 job creations a month down to maybe 0 to 50, I think he gave the range. I think there's a risk there of overeasing. I hope that they start focusing, and I think they will if I read carefully into what Jay Powell said. They need to look at the unemployment rate more than the jobs creation. It always used to be the jobs creation. But now with this negative immigration and with the downward shift in demand for jobs, supply for jobs, I think we really need to focus on the unemployment rate, which he rightly says is not terribly elevated at 4.3. You know, there's that old Psalm rule about the unemployment rate versus its moving average, and it's not triggering. It's not over 0.5 above its 12-month moving average.
As Ms. Psalm said this morning on CNBC,
no, did she?
Not quite triggered. So she's matching exact what you believe too.
There are 2 important indicators that are not high frequency. They have long lead times. And one of them is the unemployment rate versus its 36-month moving average. And it's above its 36-month moving average. And that's usually leads by a lot, but it's been above its 36-month moving average for a long time. And yet, no recession yet. Also, the yield curve, 2s to 10s, when it crosses above its 12-month moving average, you're really on watch for a recession. But when the 12-month moving average itself goes above 0, which it has on the 2s, 10s, that's has a good record of predicting that you're getting near the front edge of recession. And, you know, Jay Powell it's interesting that they've, the SEP, they increased marginally the expectations for growth, yet he sounds much more cautious about things with the confusion about the unemployment rate and the birth-death model he brought up, which a lot of economists that have been wary about the economy have been talking about flaws in the birth-death model, and he kind of acknowledged that today. And that's the primary reason in his mind for the the downgrade in the past reports of the jobs created.
If you are worried to some degree about the Fed over-easing, do you agree with the 25-point move today? Do you think that was the right move, and do you think 50 would have been a mistake?
Yeah, I think 25 is the right move. Again, it's getting more in sync with the 2-year Treasury. But I do think that it's interesting that the yield curve, it started out by steepening, and now it's flattening. And I think that's in response to the rhetoric about 50 was not even being considered. The long bond, as I've been talking about really for the past over a year in these conversations, the long bond doesn't really want the Fed to be easing a lot. The long bond likes the fact that likes it when the Fed has inflation more under control, and the long bond obviously doesn't like the budget deficit increasing. We're almost all the way through fiscal 2024, which ends at the end of next month, and the budget deficit as a percent of GDP is higher than last year, which was higher than the year before, which was higher than the year before that, which is all very surprising because we had so much stimulus back then. So what's really out of control is spending. Government spending is out of control, and I think the 3B bill that's coming into effect, I think that has too much spending in it, and I don't like the tax cuts either.
We're back here in Los Angeles with Jeffrey Gundlach. Do you agree with that assessment from Steve?
Largely, I do, yeah. I mean, I think there is a remarkable divergence of views at the Fed. I mean, one guy, the new guy, wants 5 cuts between now and year end. I think that's a little bit disturbing for the inflation outlook when we think about that it's quite possible, if not likely, that Trump is going to replace Jay Powell with somebody else. And based upon this action today of this 5 cut way out in left field, you wonder if you're not going to be running a more inflationary policy. And so it's not surprising to me that the 10-year couldn't stay below 4% and that the long bond gave it up as well, because that's not a long way away, May. It's not a long way away. And if we end up getting somebody that's going to run a very low interest rate policy, this is going to be extremely challenging for bond investors. Also, relative to the bond market, something I'd like to point out, for a long time now, we've been having the bond market supported by decent Treasury yields, and then on top of that, spreads for credit products. But the Treasury yields have been falling in recent weeks, fairly a lot. And now we're getting to the point where the Treasury yield plus the spread on some of these products, like investment-grade corporate bonds, is no longer getting to the yield bogeys that, say, insurance companies want to invest their money for their fixed-rate annuities, which have become popular. And this may end up putting, if the Treasury market rallies, and I'm not really convinced that it's going to rally further, but if it does, I don't think credit's going to keep up, because a lot of these buyers that have been supportive of credit, which has been extremely stable, other than the tariff tantrum earlier in the year, they've been solving for their yield bogey, and it's going to be harder to get if Treasury yields fall further unless spreads widen out. So I think there could be some pressure on credit spreads as we move forward.
I've asked others this question, and you sort of allude to it. I'm wondering, is this, in your estimation, the last best chance to take advantage of some things in credit as a result of what you fear could be a super dove, so to speak, in the big chair?
I think credit is fairly expensive. I don't think there's a. It's clear. It's just a statistical fact that 2 years ago, credit was incredibly cheap. You had very high interest rates. You had wide spreads on credit, and that was the opportunity. I think now the biggest opportunity to be looking for is a continuation of the trend of the lower dollar, which I think it may have. I think it dropped sharply on the cut, but then it rebounded. But if you look at, as well as assets the United States have done this year, I mean, bonds, low-risk bond portfolios that are intermediate, like benchmarked against the Bloomberg Aggregate Index, it's easy to be up over 7% year to date in a low-risk sense. And then you go to, the stock market's done really well. Foreign stock markets for dollar-based investors, which was a very strong recommendation of mine for the year 2025, have just done phenomenally well. I mean, they're up in the 20s for dollar-based investors, with the currency translation being so powerful. I just think that the dollar is going to be continuing to decline, with foreign investments in the United States has now reversed after 18 years of huge inflows from foreign investors, over $20 trillion. That's reversed in the most recent data. And I think that's going to continue, and that will put downward pressure on the dollar. Also, hedging costs for foreign investors are down, and so there'll be selling pressures perhaps on the dollar going forward. I continue to believe that non-U.S. investing for dollar-based investors is a strong recommendation, and that goes right along with gold, which has just been ridiculous over the last 2 years, up over 100%, up 45% year to date. And now even the gold miners are getting involved, which suggests to me that retail investors are starting to join the momentum trade on the gold market. I remember I suggested that gold would go to 4,000.
I was just going to ask you about
by year end. I think we got up to about 3,700. I think almost certainly gold will close above 4,000 before the end of this year.
So there are a number of things in that. I want to go back to the idea of higher inflation as a result of what's taken place in terms of the makeup of the Fed and how it may continue to evolve in the months ahead. Because there is a view that what the president's done to the Chair Powell, or what the things that he said, and Mr. Myron's presence now as a Fed governor will in fact lead to higher inflation. It sounds like you agree with that.
I think there's risk of higher inflation, and Jay Powell, he didn't dwell on this in his remarks, but he certainly referenced the idea that inflation is rising and it's under upward pressure. And so I think that the inflationary outlook is very uncertain. Jay Powell is correct in stating that we don't really know what the tariff effect, when it's going to kick in, what it's going to be. It's obviously not going to be non-zero. And in spite of the fact that the energy complex has done nothing, I mean, the crude oil has been in this 60 to 65 range for a long time. Commodity prices are going sideways, and yet gold is going crazy. I think that is a reference to the weaker dollar, which has to have something to do with higher inflation. Our inflation model, like many others, and like the price fixing in the market, really looking for a 3 handle on the CPI to end this year, maybe even as high as 3.3 on the CPI. The PCE, they always use that one. It's lower and better contained. But I think the risk of higher inflation should not be discounted or dismissed, certainly.
Does that mean that you would continue to avoid the 30-year, for example, which you've maintained with me on multiple occasions was not a place to be?
Yeah, well, it's certainly been the right place, the right idea. I mean, since the Fed started easing a year ago, the long bond is down now about 8% on a total return basis, and I think that there's a lot of risk there. There's going to be, I think, one of the penultimate question in the press conference was something about the dual mandate. Now they're talking about a third mandate, which is moderate interest rates, and I think they mean long-term interest rates. I think it's interesting that that's joining the conversation, because I believe that it's possible that there will be a yield curve control that becomes implemented if interest rates go too high on long-term treasuries. One thing, to answer your question specifically, we are only thinking of increasing our exposure down the curve and decreasing further our exposure out the curve. We actually have been short the 30-year Treasury bond and getting the duration instead on intermediate and shorter-term bonds by being long 2-year Treasury contracts. The 230 spread has gone out from inverted out to as high as about 130 basis points. It's settled in now at about 115, but I believe that that's going to continue until such time as interest rates are deemed to be too high for economic purposes. And I think most importantly is housing affordability. Housing affordability is very poor. Even with interest rates having come down, there's work at the Atlanta Fed that looks at what percentage of the median household income has to go to paying for your home, your mortgage, the insurance, the PMI if you have it, and all that. And it's gone up by about 20 percentage points what it takes. So the median household income, now the mortgage and the home ownership cost is 48% of median household income. And in urban areas, it's really outrageous. I saw a statistic today that in the Los Angeles metropolitan area, which is Los Angeles, Anaheim, and Long Beach, amazingly, the median home payment is 90% of median household income. And the way things are going, it might even go to over 100, which sounds like crazy, but it just shows that there's so many people that can't afford a home. I think it's possible that they try to manipulate interest rates to get mortgage rates down. And that would be, in anticipation of that, one has to be constantly mindful that that type of manipulation could cause a reversal in this yield curve steepening situation. I think the yield curve will naturally keep steepening until it gets manipulated. And given that the new Fed member is outrageously calling for 5 cuts at the next 2 meetings, it shows the extent to which, let's generously call it creative thinking, is being entertained by the administration and the evolving construct of the Federal Reserve.
Do you have a favorite in mind of the names that have been out there publicly on who you would be comfortable with as the next Fed chair?
I haven't really thought about it, quite frankly. I think the list is really 3 people. I think they've sort of tipped the hand on that. I don't think I would. I'm not really fond of the ones that are going to be the most malleable. But I do think the job interview, given the operation of the Trump administration, I think the job interview is going to be, will you do what I tell you to do? And if the answer is no, I think you're not going to be Fed chair. And so this is what I'm worried about with the inflationary policy. As we get towards the next Fed chair, I do think it's going to be almost a negative real interest rate type of situation. We have interest rates that are below the inflation rate.
I mean, if you strongly feel like that's likely to happen, what's the fattest pitch right now in
currency,
bonds?
Emerging market debt in local currency, which has started to perform very well. But I think that's the number one play on the weaker dollar, which remains one of my strongest convictions. And the dollar is basically rebounded off its lows today, but it was at the low of the year. I think it was lower than any time since 2022. And so it is interesting that with the dynamics that have been going on, typically you'd expect a stronger dollar, but instead we have a weaker dollar. When the S&P sold off earlier this year, almost always the dollar rallies when the S&P sold off. Not this time. The dollar actually went down by about 8% when the S&P sold off.
Well, because you've had the president himself talk about wanting a weaker dollar.
Yeah, I mean, when you run negative interest rates, if you're going to do that, negative real interest rates, you're running an inflationary policy, and that's going to lead to, I think, a weaker dollar.
What does that mean for stocks?
Well, stocks have priced in, as has the bond market, a lot of rate cuts. And one thing I've been struck by is how every time there's talk of more interest rate cuts, or that an interest rate cut is coming, the stock market rallies day after day after day, just on the same hope. Like the 50 basis point hope was, I think, exaggerated by investors, that they thought maybe we get a 50, and maybe that's what we got the last several percentage points up in the stock market. But I don't really like U.S. stocks as a dollar-based investor. I've felt that way all year, and I continue to feel that way. You're really better off in non-dollar markets, and they are all up similar amounts. There's some dispersion, but there's similar amounts on an index basis. But when you translate the currency, you end up with tremendous results out of some of these stock markets. I mean, I think, and also bond markets, like the Mexican bond market for dollar-based investors is up like 35% year to date.
But you've been a big proponent of India, and you've said it with me for at least a couple of years, I feel like now.
That's a little bit on pause, because that's one currency that's not appreciating. It doesn't appreciate versus the dollar. So this Indian stock market has not benefited from currency translation like the European stock markets have.
Well, I was also going to ask you about these sort of renewed tensions, or not even renewed, just new. Yeah. Between our administration.
That's a setback for the Indian stock market for sure. But the Indian stock market is it's a long-term play. It's one that's zero trading, just long, and don't worry about it, because the economic reforms are required to absorb all of the population that is entering the labor force, hundreds of millions. They need to restructure things the way China had to do it to absorb their huge influx of workers in the labor force that's now gone the other way. So China makes no sense for U.S. investors. There's too much tensions with China. I don't know what would happen if the market went up a lot. You might not be able to get your money out. If it goes down, you're going to own it. I just don't like the risk-reward mix there at all. India has such favorable fundamentals and a strong history of good, economic leadership actually over time, and I think it's going to return to that situation.
I've often asked you as well, like, what does the perfect portfolio for the moment feel like? Have you been thinking more about that lately, and how would you answer that for our viewers who are thinking the same thing?
Yeah, I really haven't changed very much. I'm still think gold serves a purpose in portfolios. It's at a high level on a short-term basis, but the momentum is remarkable. I love it when a market goes up a lot and then instead of correcting, goes sideways for a while. And that's what gold did. It got up to about 3,300 and then it consolidated there, and now it's on up leg. I still think a 25% type of weighting in portfolios of gold is not excessive. I think that...
Really? 1/4 of one's portfolio in gold?
Yeah. I think it's not excessive, because I think that is an insurance policy, and it's in a winning mode because of the weaker dollar, and I believe that's going to continue. So a lot of my perfect portfolio concepts revolve around weaker dollar. So foreign stocks, European stocks make sense. I think some Asian stocks, ex-China would make sense, and you do it in local currencies. So I have a big anti-dollar theme that's going through things. And like I said, for bond portfolios, I think local currency emerging markets, I think having 10% there makes some sense. I would have probably 40% in stocks, mostly, if not entirely, non-U.S., as I've suggested.
Even with the AI theme and the trend of where that is, the tremendous advancements that are taking place, you wouldn't have any exposure or such minimal exposure to U.S. stocks like those? When new technologies come, there's the sky's the limit, but it gets priced in very quickly. And I use the analogy of electricity. In 1900, people started to realize that electricity was going to change the world, and they were right. And so there was a mania in electricity stocks that actually peaked out in 1911 before there was really widespread electrification. It was all priced in. And in fact, since 1911, if you look at U.S. stocks, everything other than electricity-oriented stocks, and then you just look at electricity stocks, the non-electricity has outperformed since 1911. So it gets priced in very, very early. And the AI build-out is enormous. But it seems a lot like kind of the fiber optic stuff back in the late 1990s, where it's very real, it's happening, it's going to be world-changing, but the markets are incredibly efficient at pricing things in and often overdo it. So I am not a momentum person at all, unless there's a fundamental reason, and momentum driving things to very high valuations, if there's one thing that makes me not sleep at night is owning stuff like that, and that's just me. For some people, they'll make a fortune on it, but I think the fortunes have largely been made. What do you think of these crypto treasury strategies that have become pretty popular, I would say, in the last handful of months, and some very high-profile people, well known to our viewers, and certainly in the investing world, the Tom Lees of the world, Dan Ives, and others who are taking advantage of that? What do you think about that?
Yeah, every few years, there's something that comes up that's kind of a gimmick. And, I remember Portable Alpha, I remember 3130 strategies. I think that a lot of these things are sort of gimmicky. And so I wouldn't be involved in that at all. And
because of, are you concerned about the volatility in Bitcoin and Ethereum, and if there's a major correction of some sort, those are the kinds of assets that would be hurt the most?
Probably that's right. But I don't spend a lot of time thinking about that. I'm not a big crypto person at all, and I notice that Bitcoin has underperformed gold this year, and that's pretty remarkable given how everything's up so much. So I don't really think that Bitcoin is a very good investment. I know that people have made a fortune in it, but it's lost its momentum, and I just don't think that it's going to serve the purposes that are hoped for.
My last question, will we get a cut, do you think, at the next meeting, right before we talk to you next?
Yeah, I think we'll get a cut at the next meeting. They seem to be, he doesn't say it in plain English, but they seem to be in cutting mode. And the 2-year Treasury is still 60 basis points below the new Fed funds rate. And that, to me, suggests that the odds are much better for a cut than for a hold at the next meeting.
All right. Well, we'll talk to you right after. We'll see exactly what happens.
38th time.
Yeah, I look forward to it. We'll have just as much to talk about, I'm sure, given where things are and where maybe we think they're going. Jeffrey, thanks so much for having us out here.
Thanks. Good luck, everybody out there.
It's Jeffrey Gundlach here at DoubleLine, live in Los Angeles.